following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back once again to Volatility Views, your home for all things volatility related. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network, upon which many of you are listening to this fine program right now. And as always, before we dive into the show, I want to remind all of you to play along with us here on the Vol Views panel and surf on over to theoptionsinsider.com. You can, of course, find information on all the topics we're going to discuss today, as well as archived episodes of this program. So if you've missed an episode, that's the place to find it. Of course, you can also find them Stitcher, iTunes, and other places where podcasts are purveyed. And of course, as we are going to do today, theoptionsinsider.com also gives you your chance to join us here on our listener mail segment. You can post a comment, you can send us an email through that comment system. You can also find us Twitter, Facebook, and you can even just send us a question the old-fashioned way, questions at theoptionsinsider.com. Just be sure to put question for Volatility Views in the subject line. So we have a great show today. We're going to dive into a very, very robust listener mail segment. But before we do that, allow me to introduce my co-hosts, my partners in crime. Starting off, as always, with the heart and soul of the show. Some folks even refer to him as the Lizard. He is none other than Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Reporting to you from my igloo here in the Northeast. We're about to get a very big storm, another one of these storms for the decades type of thing, with anywhere from a foot to 18 inches of snow, which I understand for you Chicagoans is summertime, but nonetheless, a lot of snow for us.
That may have been the case back in the day, but these days a foot of snow would probably shut us down for quite a good while. We don't really get much snow in these parts anymore. Global warming and all that.
That's all we need is another snow, and then we end up with Jane Byrne as the mayor again.
That's some Chicago trivia for you there.
Yeah.
there, listeners. And of course, that shows how committed Don is. He's dialing in. He should be out prepping for the snowpocalypse, but instead he's doing a show for you, dear listeners. That's how committed he is. Got the bunker ready to go and everything. And speaking of bunkers and perhaps tinfoil hats as well, I am also joined, as always, on the program by good old Mark Sebastian from OptionPit.com. Mark, welcome back to the program, sir.
Hey, what's going on? You know, I was just using some of our historical Vol Views info actually yesterday over Twitter, disproving somebody who thought that puts were in a sale because the VIX was at 14. And so I got a chance to use that Futures Magazine article that we talked about for Vol Views 30. Don, how do you feel about that? I had a guy say, the VIX is at 14. How in the world would you ever sell a put? What would your response be to that guy?
3 words, sold to you.
There it is.
There you go. Twitter, the home of all rational and reasonable discourse.
The scary thing was it said the guy's Twitter thing said he was a professional option trader. And clearly, I would disagree with that he was.
Well, in this day and age when anyone can pretty much access high-end tools for free through a brokerage account and sit at home in their pajamas trading in quote options, I think the definition of professional has been somewhat stretched. Maybe he has no other job, so therefore he has to do this, and he may make some money at it, maybe not. But yeah, interesting stuff. Twitter, I've often found, I don't know, it's a good place for tidbits, but having a long and lengthy and drawn-out discussion on realized volatility. Perhaps Twitter, not the best outlet for that. All right, with the team assembled, dear listeners, we're going to dive right into our first segment, our Volatility Review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the program where we peer back on the week's worth of action from a volatility perspective. And Don, because the snowpocalypse is heading your way, and we may lose you at any moment, maybe we'll start with NASDAQ realized vol first. What, if anything, caught your eye in this week's activity from a vol perspective?
Well, you got to say, and Mark, Sebastian and I have been kind of hammering it home for weeks now, that those people who say, how low can you go, and it can't go any lower. A couple of weeks ago, we were at 1553 for NASDAQ 21-day historical or realized volatility, dropped to 13.17 on last week's show, and I'm now looking at 11.33. And I did a quick search to see if, we're looking at historical lows. We actually did get into single digits as recently as last September, but that September reading in the 8 handle was actually the lowest for a very, very long period of time. So not saying that we can't break the single digits again and get back to that level, but we're surely looking at what has continued to be a downtrend, not only in NASDAQ realized volatility, but of course in S&P as well, which, as Mark pointed out last week, we were sitting on a 10 reading, but as he very cleverly pointed out, that included a data point from the end of the year that was about to drop out, which was an extremely volatile day, and that was such that we could have predicted a sharp drop in 21-day realized the very next day after the program. And we're actually in the 8 handle now, in the low 8s, 8.2 for 21-day S&P volatility, which again, of course, is not at all-time historical lows, but certainly a lot below what we come to expect as usual.
And Mr. Seabass, same question to you. Let's flip it around a little bit. Look at the VIX, aka S&P 500 vol. What caught your eye, if anything, sir?
Looking at the major indexes between VIX, RVX, which is the Russell VIX, and VXN, which is the NASDAQ VIX, it's interesting in that, relatively speaking, the NASDAQ, of those, if you're looking to buy options, which some people are, the one you would actually want to buy is NASDAQ, where its implied vol is not trading at a huge premium to where realized vol has, pretty much in line with historic. So if you're, I've got the 30-day vol coming in at around 1270. If you look at the VXN is trading around 1380. Realized vol, as Don said, was over 10. So, pretty normal spread there, Don. Wouldn't you agree? 2 to 4 points is about normal, right?
Absolutely, yes.
But then if you look at Russell, where you have the RVX trading at a really nice premium, trading around 16%. Meanwhile, Russell vol has been, between 9 and 12. So, let's call it 11. So you got a 5-point premium in the Russell. And meanwhile, the SPX with the VIX around, call it 1290 is trading, you got, call it 9%. So, NASDAQ kind of toward the low end of the normal range, SPX right at that normal range, Russell really pricey relative to realized vol. So how might you trade that? Well, Don back in the day on his desk probably would have executed some sort of dispersion trade where he'd be looking to sell a bunch of expensive premium Russell and probably hedge it off buying some, either choosing not to sell premium in NASDAQ or, dare I say, buying some premium in NASDAQ. And that's actually a trade that I think makes sense right now.
That's a name that's very popular that we don't hit on very often on this show, which is, of course, Russell IWM being a very popular name out there these days. And you're right, for whatever reason, we don't tend to head towards that one because we don't really see these opportunities lining up like this very often out there. But that is certainly interesting. Certainly something to ponder why Russell is garnering this premium over everything else, over NASDAQ, over S&P these days. Certainly one to keep an eye on, I think, going forward. Maybe we'll have to start incorporating IWM in the vol review more often.
Yeah, maybe somebody thought Russell Rhodes was talking. They heard Russell talk about the VIX, and they assumed that the Russell VIX was just like, something about Russell Rhodes, and so because of that, they ran up the vol because they wanted to own premium on Russell Rhodes.
Yes, another very inside baseball joke. You're full of them today.
By the way,
I am. I love me some Russell Rhodes. I do. So
since we're talking about some other indices other than the traditional ones we usually do, I thought I'd point out something interesting, not about the actual volatility itself, but about vol and how much these volatilities will move around. We're once again at a very, very high level, not only for the S&P and the NASDAQ, at around 180 vol, which is, again, not a record, but surely pushing up there. But something caught my eye on our array of indices and all the information that we have on our volex.us website on the homepage, and that is for our European friends. We're always interesting when we get mail from Spain and Italy and France and all over Europe. I'm looking at the Euro Stocks 50, and I see 252 vol. And I said to myself, I don't follow this index very closely, but surely that's got to be some sort of, record number. And lo and behold, I take a look at the vol of this particular index that's been around for a while. You have to go back to September of 1991. I guess that must have been the long-term capital management and the Russian ruble along that period where vol was over 400 for Euro stocks. It has never come back to even trade in the 250 handle after that. And so what we're looking at now is vol for Euro stocks higher than it's been in over 20 years. So stuff going on all over the world, not just here in the United States.
Little vol percolating back onto the scene out there in Europe. Not entirely surprising, given some of the rumblings we've seen out there of late, and of course how much of a driver Europe has been over the past year in terms of moving the underlying and generating some vol across the board. So, yeah, we talked on recent shows about perhaps incorporating some commodity vol into this segment, and perhaps another good idea down the road is to start adding in a broader array of indices. I mean, everyone likes S&P 500, everyone likes NASDAQ, but there are other fish in the sea, so perhaps particularly on days like today when the Russell has some interesting developments from a vol perspective, certainly worthy of note. All right, with our volatility review complete, we're going to close out this segment and dive right into one of my favorite segments on this show, the Listener Mail segment.
Listener Mail. Listeners write in. Mailbox.
All right, and welcome to the Listener Mail segment. This is, of course, the portion of the show where you, the listener, get to join us here on the Volatility Views panel and share your thoughts, your questions, your concerns, your comments. And we're going to kick things off. We got quite a few interesting questions here. I think we'll kick it off with a nice easy one to get the ball rolling. Question from JoJo, and I love all these handles. He says, "I love the show," so thank you for that, JoJo. And he goes on to say, "Have you thought about bringing on a CTA?" And the answer is yes, we have. And we have already actually done that, even though technically he wasn't, I don't think, officially registered as a CTA. He was in the process of doing that. We had Jeff Lewandowski on a few shows ago. He is now a practicing CTA. He was in the process of getting all that paperwork set up, but he also comes from the world of commodity options and is very steeped in that. So he was a de facto CTA if he wasn't officially registered at the time when we had him on. So we had him on. Of course, we had our recent show live almost from the Board of Trade where we talked to the commodity options broker. That was pretty interesting for us to get some of the insight and perspective into that realm. So we have thought about bringing on a CTA in the past, and perhaps we will continue to do that. But in case you are really interested in the CTA realm, then we have had some guests. And as Mark Sebastian is reminding me, Jared, our friend Jared over at Conduit Options, is also a CTA. So lest I leave him out, Jared Woodard.
How dare you?
I don't think of him as a CTA, but you're right. He is. That's
what he is.
Registered in that. Yeah.
He's 100% a CTA.
I think of him as a philosophy major who sells iron condors, which of course he is as well.
Yeah, no kidding. He likes selling iron communists.
Very much a Renaissance man. Don't see many philosophy majors moving into the realm of realized versus implied volatility in iron condors, but also a CTA to boot. So there we go, dear JoJo. We have had several CTAs on the program already, and hopefully we'll bring on some more. I think it's an interesting realm for future discussion. All right, next up, Don, we have a question that is squarely in your wheelhouse. I'm thinking you're pretty excited about this one, so I'm going to wind it up and then let you knock it out of the park. A question here from Justin. I suppose that's pronounced Deveroe. He says, "Can you walk me through a few potential use cases for a NASDAQ vol contract? I like the show, and I'm intrigued by the idea. I'm just not sure that I understand how to trade a product like that." Don, I can't imagine a question that is more suited to you. So by all means, have at it.
Well, I will be delighted to answer, but at the very outset, I'd like to give Justin a reference where he can go and take a look at some very lengthy write-ups having to do with trading ideas and opportunities, not just for the NASDAQ real vol futures and potentially options and ETPs that will be based upon that, but on perhaps any other contracts as well, because these ideas are suitable not simply for an index, but for commodities, for FX, for currency, whatever the case may be. So if you go to our website at volx.us, that's VOLX.us, there's a drop-down menu on the home page. And the second item from the top says Real Vol Instruments. And that sub-menu invites you to look at Real Vol Futures. And we have a little step ladder process here for you to finally get to what I'm talking about. But under Real Vol Futures, you will see opportunities, and that refers to trading opportunities. And finally, when you get to what is actually the fourth sub-menu in that category, you'll find both expected trading opportunities and especially trading ideas for volatility contracts. And that's a particular piece that I had a great deal of fun writing some time ago, and which is rather lengthy and takes you through a host of trading ideas, starting with mean reversion, which is to say that volatility often reverts back to an average or mean level. When it's extremely low, we often expect it to go higher and vice versa. Arbitrage possibilities with other volatility instruments, including variance and volatility swaps. Naturally, spread trades against the VIX when we've talked about implied volatility versus realized, and the opportunity to trade something like a NASDAQ real vol futures. We've just been discussing levels of realized volatility for NASDAQ and S&P. You might compare that to current levels of implied volatilities and see if there aren't some sort of spread trades that would make sense to you. If you are any kind of an institutional trader and you have an entire options book, then it becomes clear that You can do some volatility hedging with a product such as a real vol futures. You can do calendar spreads, taking a look at 3-month volatility versus 1-month volatility. Compare that on the two products that would be trading on real vol futures and see if there are some opportunities there. And all of this is with the straight futures product before you would ever even consider options strategies. And so we do plan to have options on our real vol futures as well. And we've discussed on and off of the last couple of years on the show, and naturally other shows on the Options Insider Network, everything having to do with the classical or traditional options strategies, bull and bear spreads, vertical spreads, horizontals, straddles, strangles, butterflies, diagonals, ratios. So obviously anything having to do with options opens up the world for all kinds of trading where you would use the NASDAQ as the underlying and potentially do trades that are traditional for all options traders, no matter what the underlying may be. So both on our website and hopefully some ideas that I may have given you here, there's a tremendous opportunity to use volatility as an asset class, as an underlying instrument, be it NASDAQ, S&P, or any other asset. And hopefully you'll get some ideas from what I've just gone over and from the website as well.
I love it, Don. And of course, just laying out the futures, I'm sure, overwhelms some of our listeners. And you start adding the futures on top of that and talking about the realized vol perspective, I'm sure it really blows a lot of their minds. But it's interesting, I know for us here on the show, and I know for a lot of our audience, to think about that kind of stuff. And when they actually do get listed, to start playing around with them and eventually the options. That's what really excites me about all of that, I think, is just the interesting strategies and things you can execute with the options on the real vol contracts, or the real vol contracts. That's what they're called now. Or
yeah, we're going to call it real vol.
Real
one
vol.
Of these compound words.
RV.
With, REAL and then capital VOL. And I mentioned once before that we hope that the public will like it as a name. For us, it really embraces two ideas, and that is it's a shortcut for realized volatility, of course, and that's the main idea. But there's a little subtle underlying concept that as opposed to sentiment or prediction or having to do with implied volatility, this is real. This is formula-driven, actual. You can measure it, you can feel it, and you can taste it. This is real volatility. So a kind of a compound word that gets across those two ideas.
And JoJo there, you had the question before while Don was talking. I had a chance to find the exact episodes where we featured CTAs recently. So for all of your listeners out there who are interested in commodity vol and have been writing in asking us more commodity vol, please, in case you missed them, we had, of course, episode 76 recently with Rob Heineman, who came in from the floor of the Board of Trade, a commodity broker down there. We had episode 71 with Jared Woodard. We didn't really discuss commodity vol per se on that episode, but Jared is a CTA, so take that for what you will.
Guy.
He is a smart guy. Very much interesting, a Black Swan episode. And then, of course, episode 68 we did back in December with Jeff Lewandowski. All three episodes featuring a lot, or two of the three at least, featuring a lot of commodity vol, and two of the three featuring CTA. So there you go, listeners. Next up, let's mix it up a little bit here, Mark. This one might be interesting for you. I know you've been doing a lot of work out in GLD and SLV land of late. I know a lot of your clients and mentees are interested in volatility in these commodity ETFs right now. We have a question here from Little Tim, who says, why do you think GLD, I guess Tiny Tim was taken. He says, why do you think GLD is underperforming, in quotes, right now from a volatility perspective? SLV seems to be stealing all of the thunder in the volatility realm these days. So, Mr. Sebastian, what do you have to say here for our friend Little Tim?
You know, you're right. Silver's been moving better. Neither of them are really doing that much. I think the big thing you've got to understand is that silver has so many more different uses than gold. Gold is simply I like to call the gold is the short the world trade. I think Kavanaugh likes to say that. if you love gold, it's basically you're saying, I want to short the entire world. Silver is actually both industrial and a semi-precious metal. So you're not just dealing with people that are investing in silver or using silver for as a different type of commodity. You're using silver is used industrially as well. And so that is why it kind of has some action that you maybe don't get out of gold. Silver is kind of a cross between copper and gold. It's really the only one of its kind. A real interesting thing, Mark, is that after about 2.5 years of being completely screwed up, platinum is finally trading at a premium to gold again. And, I was wondering how long it was going to take, and the answer was about 2.5 years.
There you go, listeners. Platinum, once again, taking the reins as the champion, so to speak, of the metals. And Mark, on a side note...
And Mark, I would point out one other thing. I'm not an expert by any means on precious metals or their volatilities, but I did look up briefly while you were speaking what the very long-term averages are for these two metals. And if you go back, as far as we can on our website, over 25 years worth of historical data, and you look at a long-term, like a 1-year volatility, gold is, somewhere in the 17 range, where silver is somewhere in the 30 range. So simply as a commodity, silver is simply more volatile than gold, and the spread is as much as 13 points. So looking at today's level of historical 21-day volatility, we can look and say, oh, silver's about 25 and gold is very calm at about 11. And so, why is silver more volatile? But the spread between the two at current levels of about 14 points, vol points, isn't terribly different from a very long-term historical spread of about 13 points for silver over gold. So yes, it may be true that silver is more volatile than gold these days, but it seems to me at least that silver is usually a lot more volatile than gold over a very long period of time.
Yeah, that certainly seems to be the narrative, and that's what I was going to add for that, is just SLV. Well, he mentions SLV, but silver in general really just seems to be the more volatile metal in most environments. A lot of that having to do with Mark just laid out the different use cases for the two of them, but still a very interesting scenario. A lot of people do write in with some variation on this question, the comparing and contrasting of gold versus silver vol. Perhaps we'll need to dive into the metals a little bit more on an upcoming show as well, because a lot of love for these two, and a lot of people looking to trade these, particularly when we've been beating this drum on this show for so long. Let me try that again. Particularly when we've been beating the drum on this show for so long about the fact that there really isn't much vol to speak of, aside from a couple of little blips here in Russell and a few other areas, and where are we going to get any vol? People, not surprisingly, are looking farther afield, and they're looking at the commodities, in particular the metals, to generate some of that vol for their portfolio. Next up, I love this mailbag. Got so many different questions. We keep mixing it up. I'm going to mix it up again. We have a question from Theodore Grey. He says, I enjoyed your recent shows featuring financial advisors. Well, thank you for that, Theodore. And he goes on to say, but I found the reticence of many advisors to even implement basic hedges very troubling. Why do you think so many advisors and asset managers lack even basic knowledge of volatility or how to hedge a portfolio with options? Well, thank you for your question, Theodore. And you're right, it is a very troubling development. We discussed it recently on our episode with Randy Swan. I've hit on it several times in the past, talking about various issues in the advisor and asset manager community and different things I've seen that have troubled me at a lot of large industry conferences for that industry. And you're right, there really isn't much in the way of penetration. In fact, last year at the Options Industry Conference, I chaired a panel about this exact topic. Why don't more advisors understand these products? Why don't they trade them? Why don't they do simple things like hedging and writing some calls for income? And it's a very, very big problem, very, very big topic in the world of options right now, because for quite frankly, there's a number of hurdles for these people. A, they don't really get the education, things like the Series 7, Series 63, all the other examinations, the CFA exams, other exams, don't really prepare them in any substantive way to really become quality options traders. There's a little bit about options, but that's really about it. It's more perfunctory than anything else. A lot of the industry groups that might offer some sort of certification like an OCC, OIC, something like that, are very hesitant to do it because of the liability involved. So they're not going to go down that realm. So that really leaves no one out there to offer a certification in options. And also the tools are, quite frankly, not very good for advisors looking to bring options or looking to implement options in their practices. I was talking to an advisor recently, and he made a comment I've heard many times over. If you're a retail customer and you come to a brokerage firm with $2 to $3 million, they're going to roll out the red carpet for you. They're going to give you all their best margin treatment. They're going to give you all their best tools and technology. You are a king to them. Whereas if you're an advisor and you come to that same firm with $200 million under management for your clients, you're stuck with whatever backwards tools they want you to use from an options perspective. And quite frankly, a lot of these guys are still out there using covered call spreadsheets on Excel to track their positions. So there's a lot of problems there from an institutional perspective, from a firm-wide perspective on how to onboard these guys in a reasonable fashion, give them better tools, and also from an education perspective. Just a lot of hurdles there to overcome. And I think we hit on that on recent shows. And it's not specifically a volatility topic or a volatility problem. It's very much ubiquitous across the board. And it's one that I don't think anyone really has cracked yet. And an interesting question, Don or Mark, I don't know if either of you guys want to jump in on this one. Go ahead.
You know, I think there's something else that you need to be aware of, Mark. Let's not forget where a lot of money is laid, all right, and where a lot of money is traded. A lot of these companies, they claim to really be, you know, they're allegedly financial institutions, but really what they are in the business of product sales. And unfortunately, smart hedging strategies don't tie up into a nice, pretty bow very often. And so it doesn't really behoove these big financial institutions, and truthfully, a lot of advisors who are more in the business of selling than they are in the business of trading, to pull together a cognizant hedging strategy that uses options, despite the extra commission they might get. Because for the most part, most of these guys would rather place you under with some money manager, collect your 1%, pay the money manager 0.25%, and forget about you. So the idea that you know, it's a systemic problem because of tools available, yes. It's a systemic problem because of education available, yes. It's also a systemic problem because the system itself is a little screwed up when it comes to hedging and what they're selling and really whose best interests they're really looking out for. Sorry to be so, cynical about it, but it's just the truth, guys. There are very few of these people that care about your assets as much as you do, and there are even fewer big companies that care about your assets as much as you do.
You know, that's a good point, and that's something I've brought up many times on our network in the past. There are two discrete skill sets when it comes to these money management firms. One is very much sales, and pretty much all the firms that are successful in that realm have to excel in the former in order to get you on board. And most of them put all their effort and skills, and they're really, like you said, Mark, sales firms. And the second part, the actual part of their job that they're supposed to be doing, the actual money management part of their job, is very much secondary. And that unfortunately is the truth of the matter. And that problem, combined with everything else we discussed, really combines to make a unpleasant, somewhat jaded picture of the financial realm, but advisor realm. But I think that's closer to the truth than a lot of people are willing to admit, unfortunately. So there we go. We brought the tone of the show down. Don, you have anything to add on that?
No, I would just say to you that it's really kind of hard to believe, but in my heyday when I was at Morgan Stanley and we were educating the public about options, they had been around for so long that it seemed to me that it would just be a given that most of your retail people and most of the people that you and Mark have just been discussing would be kind of up to speed on all of this, and hedge fund managers and mutual funds and what have you would be incorporating options strategies, and I was absolutely dumbfounded to learn, I can't tell you what the date was at some particular time, that only 10% of people who were running money at that same time that I was just talking about ever used options in any sort of way whatsoever. Now, I'm sure that number's come up since what could have been, 20 years ago. But even at the time, I was just struck by that. And now we could say a similar thing. All of these volatility products and VIX, household words, they've been around for quite some time now. You would think that all of these people who are running money and advisors would be up to speed on this and would be using them. But again, if you took that kind of a poll today and you asked, how many people are using any kind of volatility products whatsoever in their daily management of money, I'm afraid the number would be appallingly low and a surprise even to us in terms of what you would expect.
Yeah, that's kind of the scary and the sad thing, Don, is that the percentage really hasn't increased dramatically since you were doing this back in the 80s and 90s. It just really it hasn't grown anywhere where it should be, quite frankly.
Well, and some of these big firms are actually backing away from options. They're afraid to even let their managers do that. I have a manager who with a particular firm that was really doing some good things with options. And compliance just put the absolute kibosh on it because they're too afraid of arbitration, yada, 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 because they don't understand what they're dealing with. It is absolutely ridiculous the how some of the large operations function and how they manage their risk. The types of things, they basically allow their own individual clients to take positions that the bank itself would never take. And that's what I think is really crazy.
I think some of these large institutions would be well served by listening to this program and perhaps a few others on our network to make them a little bit more well-versed in the things they are supposed to be well-versed in already, but don't want to admit to anyone that they are not. All right, we're going to mix it up yet again. That's a great question there, Theodore. Thank you for that. Next question comes in, a lady listener, don't get too many of these, and also writing in from a long way out from Anchorage, Alaska. So there we go. She's a devoted fan, obviously, if she's dialing in all the way from snowy Anchorage. She says, I have about $25,000 in my trading account. I've learned a lot about the realized versus implied discrepancy by listening to this program, and I would like to capture that in my own trading. Unfortunately, delta neutral trading is pretty much out of the question with my account balance. What do you recommend for a guy like me who would like to practice what you guys preach, but doesn't have access to an institutional level account? I'm sure many of your listeners are in a similar situation. And you're right, Ali. I think a lot of our listeners are probably, on the retail side anyway, are in a similar boat to you. And so this is a topic that has crossed my mind many times. And you're not exactly correct. There are some things you could do. But before I dive into those, I can hear Don champing at the bit over there. I know he wants to dive in on this one. This is his favorite topic, realized versus implied vol discrepancy. So Don, why don't you dive into this one first for our friend Ali from Anchorage?
Well, first I would point out, since somewhere in the letter they said, what would you recommend for a guy like me? It's probably Ali is not
you know what? It's probably a husband writing on his wife's email or something like that. I didn't even realize that. It's hilarious.
One of the things that I would point out that I think is going to be exciting for when we bring out our realized volatility products, but that can also serve as a general recommendation even for someone today trading the implied volatility suite of products, is that we have not only the futures contracts that often have higher multipliers and even with rather low margin requirements can consume a decent amount of capital, especially for someone with a $25,000 account, but there are the ETFs, ETNs, the products that do not have multipliers, but that trade as if they were a stock with the dollar value or the numerical value of the underlying. So when you're talking about a VIX at 15 or 20, or a realized volatility product in S&P that could be as low as 10 or 15 nowadays, if it were trading, you realize that these ETFs are tailor-made for the smaller accounts and for our retail clients, where basically you would actually simply be putting up the dollar amount that corresponds to the numerical value that you're trading. Even now, as we contemplate launching our real vol futures that we were talking about before, we are still not 100% sure whether we're going to go with a 1,000 multiplier that would make, let's say, a 15 volatility, a $15,000 product. And of course, with futures, you don't put up the full amount, but you put up a certain percentage of that as a performance bond or maintenance margin. But we are very seriously contemplating the idea of going with a $100 multiplier that might make such a 15 handle contract 1,500 in notional value, and that would be perfectly tradable even for someone with a $25,000 account. Yet again, we contemplate not only options, but ETPs on these real vol futures and on our products. And there again, that makes the ability to trade volatility, whether realized or implied, or spread trading, perfectly attainable and possible for an account of the level that Ali is talking about. So I can only speak from our end that we're surely not going to forget the little guy, and we're going to make sure that we have products that are perfectly tradable, not just for institutional clients, but for everybody across the spectrum.
Well said there, Don, and you're right. You can't forget the little guy. They are a growing part of the equation these days. I know we have a lot of institutional and very high-end listeners on this program as well, but we also have our fair share of people who want to improve their trading and want to learn more about these topics, like Ali or perhaps her husband.
Yeah, and you know what? There are the things to remember in terms of actual options is there are complex spreads, and you can trade options around options. So, you know, even if you don't have a huge account, if for some reason you end up gamma scalping, which you shouldn't, you know, you can sell options against a long gamma position. You know, we trade things like condors and butterflies and calendar spreads, which are complex spreads that have relatively low margin that allow you to sell premium. And so there are smart, thoughtful ways, if you learn how to do them, that you can engage in, you know, the type of trading that, you know, 95% of the trading that market makers and professional upstairs guys do. But the only type of complex spread you can't do on an account that size is like a short calendar, and you can even do that in the futures market. So, you know, there's not as much that is closed off to you with a $25,000 account as many of you think.
Yeah, you know, it's an interesting point, and that's something I think we've brought up here on this show and on many other shows in the past, and it's worth repeating that there is this perception out there that you have to have $100,000 or more to really do anything of any significance in the options realm, and that certainly is not the case. Mark and Don just pointed out a number of options. Of course, you know, gamma scalping, probably not the best thing or the easiest thing to do in an account of that size. You could do it if you really wanted to, and you could use options.
That's why.
Not ideal, but still obvious.
Don't do that.
Yeah, exactly. You could if you were perhaps a little touched in the head, shall we say, or you had some real reason to want to do that, but you could. You know, that's one way to do it, hedging with options. And I think, like we've said many times in the show, spreads are really the ideal way to go. That's a good way to try to capture a lot of these discrepancies. You know, you don't have the capital to really do some of the things we're talking about, like, you know, and obviously the realized vol contracts are not listed yet, but once those are out there, that'll be a home run for you here, Ali, and or your husband/boyfriend or whoever else is writing in on your account to ask this question on your behalf. Here I was all excited. We had a woman writing in from Anchorage, and Don just blew all that away in my mind now.
He crushed you.
Yes, he did. All right, second to last up, actually, here is a question from Monster6, another great handle. He says, correlation is a growing concern across asset classes. It's all but impossible to diversify away risk in this marketplace. Would you guys advise your listeners that a volatility/derivative component is the best way to truly hedge/protect a portfolio these days? If so, what would you recommend? Monster6, we've hit on this a number of times in the past. I was at a conference recently for asset managers and advisors, and they were talking about this specific scenario, not so much the options component, but I added that in later at the conference, and I don't think they were too enthused by that. But they were discussing how, modern portfolio theory said, well, if you had 20 different assets in your portfolio, you were essentially fully diversified, and given the growing correlation in asset classes, now that number has grown to over 40, which of course, if you think about it rationally, it gets getting to the point of absurdity. Just adding more assets, more equities, whatever the case may be, into your portfolio in an attempt to diversify and protect yourself is very much a fool's errand. So all the strategies we've outlined on this show, I think all of us would view as much more preferable to just buying more stocks in your portfolio, hedging with long puts. Don, cover your ears. I mentioned buying an option. Put spreads, condors, collars. If you're worried about outlaying for premium, you can add the writing component. There's a lot of different things we've discussed on this program many times. Ratio spreads. Go back. I'd encourage you and listen to our archives. We've walked through this many times in the past, but we've outlined on this show many times the number of things you could do versus just buying more stocks in your portfolio. Don, Mark, I'm assuming you guys are on board with that.
Yeah, not only that, but interestingly enough, and this is for way down the line, we at the Volatility Exchange are actually developing and have the patent already on a correlation contract, because the problem that was brought up here, and it's rather mathematical in nature, I don't think we're going to get into it at this time, is that in fact, when you think you may be very well diversified with a great number of different assets that are supposed to be, either negatively correlated or have zero correlation, you often find that when some sort of global event or some sort of catastrophe takes place, that all of a sudden many of these assets all move in the same direction at once, and often potentially to the downside. So if you owned an instrument there where you actually profited from an increase in correlation that often takes place when there is this very strong down movement, that could potentially serve as some sort of a hedge as well. So this is something for another time down the road in the future, but something that also may one day be incorporated into portfolios as a potential hedge when the diversification or the zero or negative correlation that you think you have actually turns out to be somewhat different in periods of stress.
All right. Thank you for that, Don. And of course, thank you to everyone who wrote in and joined us here on the old listener mail segment. I know I love this segment. I know Mark and Don do as well. It really gives us a chance to connect with you, the listener, and see what you guys are thinking about. And your questions ran the gamut today, and we love that. We love all kinds of questions about all different types of subjects. If we didn't get to your questions, don't worry. We'll get to them on an upcoming show. Not next week. We have a guest coming up, but perhaps the week after that. So thank you again to all of you who wrote in. And now it's time to roll on to our final segment, the Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and those mournful piano keys mean it's time for our final segment, the Crystal Ball segment, where we peer into the future and attempt to determine what the volatility gods hold in store for us for the coming week. And we've hit on it quite a bit over the past week, past couple of shows, I should say, really, about really not too many sources of vol out there, but things are changing up a little bit out in vol land. And perhaps the Russell is our salvation for giving us a little bit of action for the week to come. Is that where you're focusing a lot of your efforts right now, Mr. Sebastian?
Yes, that is where I'm focusing my efforts right now. No, I mean, realized vol's been low. I was kind of worried that the market might start. We've seen an incremental increase in realized vol from insanely insane low to just low. And I think that's kind of where we're going to be for the balance of the month. And we may, I think sequester might be priced in. We may sit here and if there is any realized volatility, I think it's gonna be to the upside, as we're sitting at a new high since 2007 in S&P, in DJX, and in not in DJX, but in S&P and a few other stocks. So there's definitely reason for belief that we may continue this kind of slow crawl higher.
Yeah, it seems like a lot of the days we've experienced any realized vol lately have been to the upside. So I probably wouldn't be too far out of left field to predict that coming again going forward. And Mr. Don, what say you for the land of NASDAQ and other volatility products / indices?
Well, of course, Mark made an interesting comment. We're low, but we're not insanely low. And I think that's a very intelligent comment, and I happen to agree with it. You look at these numbers and you say, gee, single digit 8 for the S&P, I'm talking about realized volatility, or 11 for NASDAQ. And yes, without question, they're low. But as I said at the opening of the show, they're not at historical lows. They're not at the lowest numbers we've ever seen. And it's not as if you could really sit here and say, I just think it's ridiculous to say that they could be going any lower. And we've spoken over and over and over again on the show about the inverse correlation, certainly between implied volatilities and actual asset prices, equity prices in particular. And that correlation, while not as strong negatively, is surely negative for realized volatility and index prices as well. And so if you subscribe to the belief, as Mark does, and I think I do as well, that we still have more upside to go, most of the gurus and pundits are predicting, if not double-digit, at least single-digit increases for the major indices over the course of this year. And if you subscribe to that, and that we might do so in some sort of orderly fashion and simply ramp our way up as we seem to have been doing lately, then the most likely scenario for both implied and realized volatility is that we could actually go lower, and that could actually persist for several months. So I'm going to put myself in that camp for a while, and we'll see what happens.
So you're in the sell until May and then come back camp, perhaps. Flipping the conventional wisdom on its head. All right, thank you for that, Don. Thank you for that, Mark. And unfortunately, that's all the time we have for this episode of Volatility Views. But before we go, I like to check in with my cohorts here, my partners in crime on the Vol Views panel, to see what's coming up in their respective necks of the woods that may interest you, dear listener. See, everything we do for you, the listener. So, Don, first up, what is coming up that may intrigue our listening audience over in the land of Volex and Volex.us?
Well, it's been a quiet week in terms of the website and in terms of our ongoing negotiations, but we will keep everybody posted as that goes along. And I'd like to simply reiterate, because so many of the questions that our listeners have, I often say, why don't you go to our website and take a look at this portion or that portion or whatever. We really have built this up to contain a wealth of information on all aspects of volatility, including all sorts of scholarly articles, historical data, charts, and all sorts of ability to pull up detailed information, whether you're simply mildly curious or whether you're a serious researcher. So as a resource tool, we're rather proud of the site, and we'd like to make sure that all of our listeners take a little time every now and then to peruse, and maybe each time you look, go to a different section, read through some articles that you perhaps haven't read before, and systematically work your way through. Might take you a little while, but I think you'll learn a little bit, and go have a look at volex.us.
There you go. And Mr. Sebastian, I know you just concluded a webinar that may interest a lot of our listeners.
Yeah, we did using the VIX as a trading indicator. You can talk to Mike Tusaw if you want to get your hands on that. We're going to be doing a webinar on February 20th. Me and Andrew and the guys from the Option Vision, which is Andrew's software company, and we're going to be kind of showing how to take advantage and execute trades. That'll be that should be a fun one. And then we got a lot of stuff coming on. I think I'm going to be on TV next week. We'll see, and that'll be interesting.
Yes, surf on over to Mark's site. I'm sure you guys are going to have a link to the webinar for the archives, or, of course, I think you can go to rcmaccess.com, I believe is the website for those guys as well over there. They'll have a link to it up there as well. So if you missed the archive, and I'm sure if you're tuning into this show on Monday, you did, then by all means check out the archive, because I think you'll like what you have to find over there. And, of course, speaking of archives, by all means, surf on over to theoptionsinsider.com. You can find the complete archive of this and every other program on the Options Insider Radio Network, as well as detailed analyses and discussions of all the topics we hit on the show today, education, unusual activity alerts, all that fun stuff, as well as breaking news from the options market. And, of course, you can join your fellow listeners here and sound off for our listener mail segment. A lot of fun stuff to do over there at theoptionsinsider.com. And, of course, before we go, all of us here on the Volatility Views panel want to thank all of you out there in the listening audience, particularly all of you who took the time to write in. We love hearing from you guys. Keep it up. It's really what makes this show such a fun show to do on such a regular basis. And, of course, we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.